Not in cash. Not in gold. Not even in a vault. It exists because everyone involved agrees it exists. And the moment they stop agreeing, it vanishes. That's not a glitch in the global economy. That is the global economy. Right now, headlines are full of numbers, debt totals, market caps, GDP, trillions here, trillions there. It feels concrete, heavy, mathematical. But under all of it, the system runs on something fragile. But on the top. Confidence. And that's why this matters right now. Because when confidence wobbles, money doesn't slowly leak out. It disappears fast, all at once, everywhere. Let's rewind. Imagine you walk into a store and hand over a $20 bill. The cashier accepts it instantly. No questions, no test, no hesitation. Why? Because they're confident the next person will accept it too. That's it. That piece of paper isn't valuable because of ink or cotton fibers. It's valuable because of a shared assumption that it will keep working tomorrow. Now scale that idea up. Banks don't keep your money in a box with your name on it. If they did, the system would collapse in a week. Instead, they lend most of it out. Your money exists as an entry on a screen, a promise. You're seeing trust. When you check your balance, you're not seeing cash. Trust that the bank is solvent. Trust that withdrawals will be honored. Trust that everyone else won't panic at the same time. That trust is doing far more work than actual cash ever could. Here's where it gets uncomfortable. If everyone tried to turn their digital balances into physical money tomorrow, there wouldn't be enough, not even close. And yet this doesn't scare people, because confidence is high. The system only breaks when confidence breaks. History makes this painfully clear. Financial crises rarely start because money runs out. They start because belief does. In 2008, the world didn't wake up one morning with less wealth. The factories were still there. The workers were still skilled. The houses didn't vanish overnight. What vanished was confidence. Banks stopped trusting other banks. Lenders stopped believing borrowers were safe. Investors stopped believing the prices they saw were real. The math didn't change. The stories did. And once confidence cracked, everything else followed. Credit froze, markets fell, governments panicked. Not because the money was gone, but because no one trusted the promises behind it anymore. That's the hidden mechanism most people never see. Modern money isn't a thing, it's a relationship. A bond is a promise. A loan is a promise. A currency is a promise that other people will accept it later. The global economy is essentially a massive web of IOUs stacked on top of each other, reinforced by belief that tomorrow will look enough like today to make those IOUs safe. And when that belief weakens, even slightly, the system starts demanding proof. Higher interest rates. Tighter lending. Stricter terms. Confidence pulls back. The economy slows, not because people forgot how to work, but because trust became expensive. Here's the irony. The more complex the financial system becomes, the more it depends on confidence rather than cash. Trillions of dollars move daily across borders without a single physical bill changing hands. Central banks inject liquidity by adjusting numbers on balance sheets. Markets rise and fall based on expectations, not outcomes. A single sentence from a central banker can move more money than a year of tax collections. That should tell you something. Hype says markets are driven by fundamentals. Reality says they're driven by narratives about fundamentals. When confidence is high, bad numbers are ignored. Losses are framed as temporary. Risk is renamed opportunity. When confidence drops, even good numbers are questioned. Profits aren't trusted. Safety becomes the only goal. Same data, different belief, completely different outcomes. This is why governments obsess over confidence. They don't just manage economies, they manage expectations. Why do officials say things like, the system is strong during crises? Why do central banks signal future moves instead of surprising markets? Because confidence is easier to preserve than to rebuild. Once trust breaks, it doesn't come back with a policy announcement. It comes back slowly, painfully, after damage. And here's the quiet absurdity. Everyone knows this system is fragile. Everyone knows it's built on belief. and yet everyone acts as if it's solid, because acting otherwise would make it collapse. It's a collective performance, a necessary one. This is also why panic is so dangerous. Fear spreads faster than facts. A rumor can do more damage than a bad earnings report. A viral headline can drain liquidity faster than a recession. Confidence is social. It moves in herds. And the global economy isn't designed to survive mass doubt. It's designed to survive individual skepticism. One person patting money out is fine. Millions doing it at once is catastrophic. So the system constantly nudges behavior toward calm. Insurance guarantees, backstops, bailouts, reassuring language. Not because everything is fine, but because believing everything is fine keeps it functioning. That's the uncomfortable truth. The economy doesn't run on cash. It runs on the assumption that tomorrow won't be chaos. Which raises the real question. What happens in a world where confidence becomes harder to maintain, where information spreads instantly, trust in institutions erodes, and every crisis is live-streamed in real time? If belief is the fuel, and belief is weakening, what replaces it? Because once confidence is gone, no amount of money can buy it back instantly. And the global economy knows that. That's why it's quietly terrified of doubt.